Good morning, everybody. My name is John Delmas, and I'm the Executive Director of the Michigan Chemistry Council. I want to welcome you all today to our webinar, Understanding and Implementing Climate Commitments from ESG to EHS. We're going to get started right away here to maximize our time. We do have quite a bit of content we're looking forward to sharing with you all. We appreciate you joining us this morning for this extremely timely and relevant subject matter. We are hosting this with our friends from the Ohio Chemistry Technology Council. So we appreciate them helping to promote it and get it to their members and being able to partner with us on this. Again, this content and issue that's very near and dear to our companies as well as to our associations. So I wanted to give a few notes just to begin with to get it out of the way so you all are aware. We are recording this webinar and we will be posting it for later viewing. Hopefully as of later today still. We also, of course, have the presentation slides, so you don't need to take notes. There are quite a few, some really great content, some great visuals and information that our presenters will be sharing. So those who have registered will receive a link to the recording as well as a copy of the presentation slides and a little bit of follow-up information. We will have plenty of time for questions at the end of the webinar. We have a two-part of our different presenters, two-part panels, and we're going to be taking a 5-minute break in between. That'll probably be at the top of the next hour. And so we request that you submit questions using the Zoom Q&A feature. Hopefully that's obvious enough. And we look forward to wrapping things up, putting a real good bow on everything at the end and taking questions that may come in. So we encourage you to submit those. And lastly, hopefully you can learn something today, get some great valuable complementary content, but also if you're looking for any CEU, I can speak on behalf of the Michigan Chemistry Council. We can offer a certificate for 2 units for the 2 hours, usually for people's PE. And Jen and Andy at the Ohio Chemistry Technology Council indicated they might do the same. So please follow up with us directly if you're interested in that CEU. So with that, I wanted to just introduce our 3 presenters today. Again, we come in 2 different pieces. And to begin with, we're going to have Rich Pendulu and Sanduni Lianagamagi from Trinity Consultants. Rich is the director of Trinity's EHS management practice area. In this role, he collaborates to address client concerns with climate change strategy and GHG emissions management, EHS management systems, environmental sustainability. So very much relevant to today's program. He manages complex assignments dealing with air permitting and compliance, climate change programs, auditing, and business sustainability strategy. He has more than 25 years of diverse environmental management experience, and he has advised clients across a broad array of industry sectors and governmental entities. He has his master's of environmental management from Duke University and a bachelor's degree from biology and environmental science from Wake Forest University. So he is a North Carolina guy through and through. And he is also a certified environmental management systems auditor, a lot of letters behind his name, and a certified ICPM manager, if I have that correct. So very well qualified. And his colleague, Sanduni Lianagamagi, is a senior consultant with Trinity Consultants EHS performance and risk management practice. She's also based out of the North Carolina office. Her primary responsibilities include GHG verifications, sustainability reporting, scope 3 quantifications, which is some sort of sorcery and wizardry that we'll have to figure out, auditing and evaluation and implementation of EHS management systems. She is originally from Sri Lanka, but has lived in Canada, the UAE, and the US. And her Bachelor of Science degree is in chemical engineering from Georgia Tech, but she is also currently pursuing her master's degree at Duke University. After the break, we're going to welcome our 3rd presenter, and that is Mike Trupas, who is a managing director at Foresight Management. He is a certified energy manager and a certified procurement professional. His designations are from the Association of Energy Advisors. His bachelor's degree is in civil engineering from Calvin University, where I'm at here in Michigan. Mike is a self-declared energy nerd who has spent the last 10 years learning everything he can about the energy management industry. He thrives off the complex and rapidly changing nature of energy and sustainability. And Mike is in his element when empowering industrial companies to come up with a plan to reduce energy consumption and cut utility costs. And Mike will take care of some of that content on the second half of our program tonight. So with that, I'm going to turn it over to Rich and Sanduni. You guys may share your slides. They have quite a few. Appreciate everybody again for joining us and appreciate our presenters for bringing this content to us today.
All right, good morning, everyone. It's great to be with you today. We appreciate the opportunities to share some ideas with you. Sanduni and I are going to cover what I would call the foundational elements of responding to climate risk and building a robust climate change program within your organizations. So we'll start off with some background on the drivers that are mostly non-regulatory drivers these days that are kind of coercing companies to move toward building a robust climate change program. So Sanduni will cover the first half of our presentation. She'll hit the background information on ESG sustainability drivers, what a net zero carbon commitment means, kind of distinguishing that along with climate neutral commitments, and then talk about the platforms that you might avail yourselves of to provide your information into the public realm. Then I'll pick up on the second half, talk a little bit about the basics of GHG quantification, what it means to put together a GHG and energy management program, and then try to discuss a little bit about the interconnections between sustainability and some other programs you may already have in place for managing environmental issues, such as ISO 14,000 environmental management systems. So with that quick background, I will turn it over to Sanduni for the first part of our presentation.
Hello, everyone. My name is Sanduni Lianagamage, and I would first like to thank you all for having us here today. I'm going to kick us off with some definitions. So the word sustainability and corporate social responsibility has been used interchangeably the past few years, but it's good to understand the differences between these terms. The definition that is most frequently referenced for sustainability is the one by the Brundtland Commission back in 1987. And it's this idea of meeting the needs of present generations without compromising the ability of future generations to meet their own needs. It describes the ability to maintain various systems and processes environmentally, socially, and economically over time. However, corporate sustainability is this approach where you're aiming to create long-term stakeholder value through the implementation of a business strategy that focuses on the ethical, social, environmental, cultural, and economic dimensions of doing business. And then finally, the term corporate social responsibility, also known as CSR, is this idea of a business operating in a way that enhances the environment and community while accounting for interest from all your stakeholders. So what's ESG? It's a term that has been continuously growing in importance, especially among investors. Environmental, social, and governance criteria are an increasingly popular way for investors to evaluate companies in which they might want to invest in. Environmental criteria consider how a company performs as a steward of nature. Some examples here would include, how is a company reducing your waste footprint or following any biodiversity practices on the lands you operate on? Social criteria examine how a company manages relationships with the people that are affected by its operations, such as employees, suppliers, customers, and the communities where it operates. Some criteria here includes employee health and safety policies, a company's stance on human rights, and handling of consumer protection issues. Governance in the context of ESG is essentially how a company is managed by its board of directors and executive management. So governance deals with a company's leadership, executive pay, audits, and shareholder rights. So together, these three aspects make up a framework to evaluate the issues pertaining to a company's long-term health and prosperity, not just financial returns and profits, and is often referred to as a stakeholder-centric approach to doing business. So as Rich mentioned, there are many drivers for ESG reporting, but three of the key groups that affect businesses are regulators, investors, and customers. The ESG reporting landscape varies largely country to country from a regulator perspective, but When looking at the US, it's important to consider any pending SEC requirements, which I will touch on in the next slide, and states that are working together to develop policies to address climate change, as we're not seeing much movement on the federal level. And the biggest driver, as I mentioned earlier, are the investors. The Task Force on Climate-Related Financial Disclosures, also known as the TCFD, was created to improve reporting of climate-related financial information because investors want to understand the impacts of climate change on a company and how well these companies are positioned to transition to a low carbon economy. And finally, from a customer perspective, more and more suppliers and vendors are seeing increasing customer requests for metrics around sustainability. So as some of you may have already seen this in the news, last Monday, the SEC proposed a new rule that would require businesses to report on greenhouse gas emissions and any details around climate change posing a risk to their business. The disclosure requirements are similar to existing frameworks and standards, such as the TCFD and the Greenhouse Gas Protocol, which is the most widely used international greenhouse gas accounting tool. I will not go through all the disclosure requirements here, but it is expected that companies will be required to report on many categories of the greenhouse gas emissions and information around climate-related risks and material impacts on the business. The rules would be phasing in stages, so companies will not be expected to file information till 2024 at the earliest. However, companies that are still beginning their sustainability journey are encouraged to continue putting the appropriate systems in place to collect the necessary data to make the process easier if the rule is approved. So companies have become aware that environmental and social issues can impact their bottom line, and they're seeing that sustainability is a critical driver of profit and resilience. Companies operating more sustainably benefit from cost savings, managing risks better, driving innovation, and building brand value. They're just more profitable this way. What we want to convey here is that sustainability is creating long-term value for a company. So now I will move on to a quick overview of how companies are approaching their net zero commitments. But before diving into the different carbon commitments and goals, it's important to understand the different categories of emissions that companies account for. For some of you here, the terms might be second nature, but we will cover each scope just to give a quick overview. The Greenhouse Gas Protocol outlines 3 different scopes that help define the various direct and indirect greenhouse gas emissions of a company. Scope 1, Scope 2, and Scope 3. Scope 1 accounts for all the direct emissions from sources owned and or controlled by the company, such as company facilities and company vehicles. Scope 2 accounts for any indirect emissions, such as purchased electricity, steam, and heating, cooling for own use. Scope 3 emissions includes all sources not within an organization's Scope 1 and 2 boundaries, and it accounts for any activities from assets not owned or controlled by the reporting organization, but has an indirect impact on the value chain. So we could probably spend a few hours talking about Scope 3, but with the limited time, we will just provide a broad overview of what Scope 3 means. It is the most complex category of greenhouse gas emissions and is not as straightforward to define its boundaries and collect the data needed to calculate its emissions. It's also typically the largest portion of a company's greenhouse gas inventory. Scope 3 allows a company to assess where the emission hotspots are in their value chain and engage with suppliers to implement greenhouse gas reduction initiatives. In addition, though there's no specific requirement to report Scope 3 emissions as of today, there's increasing pressure from investors, customers, and even employees to begin evaluating Scope 3 emissions. And finally, this slide provides an overview of how the Greenhouse Gas Protocol separates the different categories of Scope 3 emissions. There are a total of 15 categories, 8 within a company's upstream operations and 7 downstream. And only a few categories may end up being relevant for a particular company in a specific industry. Category 3, for example, covers fuel and energy-related activities, which would account for emissions associated with extraction, production, and transportation of fuels and energy purchased by the company. And if you look at category 12, which is the end-of-life treatment of sold products, which may be more relevant to the chemical sector, it involves calculating emissions generated during waste disposal and treatment of products sold by the company at the end of their life. Now that you have a good sense of how greenhouse gas emissions are categorized, I will move on to provide some background on greenhouse gas targets. During the United Nations Climate Change Conference in 2015, COP21, a legally binding international treaty on climate was adopted, which is also known as the Paris Agreement. And its goal is to limit global warming to well below 2 degrees Celsius and preferably to 1.5 degrees Celsius. To reach the 1.5 degree goal, emissions would need to be reduced by 45% by 2030 and reach net zero by 2050. So why is it important for a company to set a greenhouse gas reduction target? One of the primary reasons is that it helps a company assess and manage relevant climate-related risks and opportunities while preparing for any upcoming regulations or policy changes around climate change. And by developing voluntary GHG disclosure data when setting a target, a company is prepared for any potential ESG reporting requirements. Though many businesses are pledging to get to net zero emissions, it's also important to check whether these pledges are science-based. Targets are considered science-based if they're in line with the level of decarbonization required to meet the Paris Agreement's global temperature goal that was described earlier. A need for supporting companies in setting and working towards these targets has actually resulted in the formation of the Science-Based Targets Initiative, which is a partnership between CDP, UN Global Compact, World Resources Initiative, and WWF. The SBTI provides methodologies and tools that many companies have been using to align their corporate greenhouse gas reductions with global emissions targets. So now that we have covered science-based targets, what does it mean to call a target net zero? In short, net zero is when a company is able to reduce emissions consistent with the Paris Agreement goal, in addition to neutralizing the effect of any residual emissions that are not feasible to eliminate. So this is when a company goes beyond the science-based targets by ensuring that they're taking responsibility for emissions that they are no longer able to reduce. And this slide was really prepared to show the many different goals and targets that are being made within the chemical industry. Some companies begin by stating their commitment to set a science-based target as RKMA, while others have completed the step of committing and then setting their targets, which have been validated by the Science-Based Targets Initiative. Now we'll go ahead and do a quick summary of ESG disclosure platforms. I want to note that this is not a comprehensive list, but we have included ones that are mostly used in this industry. SASB, also the Sustainability Accounting Standards Board, is a resource under the Value Reporting Foundation, which was actually recently formed as a global nonprofit that works towards supporting businesses and investors in understanding enterprise value. SASB specifically provides metrics that ease the disclosure of financially material sustainability information to investors. There's a total of 77 industry-specific standards with accounting metrics for each of the disclosure topics. SASB also has a standard for the chemicals industry based on sustainability risks and opportunities specific to the sector. So a useful tool that SASB has come up with is a materiality finder. Based on market feedback, SASB provides topics that are financially material to a specific industry. So the list here are the different sustainability topics that companies in the chemicals industry can find to be material. There are many environmental topics that are material to the chemical industry, unlike social capital and human capital. However, it is important to note that there's a lot of flexibility on which topics a company would like to report on based on sustainability issues specific to their own business model. So for example, under human capital right now, you see that employee health and safety is listed, but some companies may find employee engagement and D&I practices to be more important. So it's very possible that you will be adding more topics under your SASB disclosure based on your business model. Some of you may already be familiar with EcoVadis. It's the world's largest provider of business sustainability ratings, and it has a global network of more than 85,000 rated companies. They have developed their own ratings using international sustainability standards. There are many criteria that contributes towards the score a company receives, including the following environmental assessment criteria. GRI, also known as the Global Reporting Initiative, is the world's most widely used sustainability reporting standards. Unlike SASB, GRI has a focus on environmental, economic, and social impacts of a company in relation to sustainable development. Some companies find it useful for the materiality process, while others prefer different frameworks due to its complexity. So it really depends on what a company is looking for when they're beginning their sustainability journey. For any professionals here who have had to provide greenhouse gas data to your sustainability teams, you may already be very familiar with CDP. CDP is an independent not-for-profit organization headquartered in the UK. It's the largest global disclosure system that helps companies and cities manage their environmental impacts through questionnaires on topics such as climate change, water security, and forests. Companies can gain a competitive advantage by reporting through CDP, especially due to the growing request for climate change data by investors and customers. So as you can see, there's many different terms and many different platforms out there when it comes to ESG and sustainability. So there's a growing need for the integration of sustainability disclosures for more consistency and quality in the data being reported. So this need has led to the formation of the International Sustainability Standards Board back in November 2021 at the United Nations Climate Change Conference, COP26. Two existing groups have already joined the sustainability initiative, including the Value Reporting Foundation, under which the SASB standards are housed. So the latest update on ISSB is that we can expect to see their first set of standards by end of 2022. So now I will pass it on to Rich to talk about the development of greenhouse gas quantification programs.
Thank you very much, Sanduni, for an excellent background on the drivers and disclosure platforms. Before I get into my section, I would have to say that as a person who's been involved in EHS and sustainability management work for several decades, I'm really amazed at the power of stakeholder drivers that has emerged in the last decade. So the things that we're talking about today that are prompting action by companies are primarily stakeholder drivers, and they are every bit as significant as what typically might happen in the regulatory sphere. I'm not saying that we won't see regulations in the future around greenhouse gas emissions, but at a national level. But right now, the stronger drivers really are stakeholder drivers, and they are really prompting action. So, you know, it's a business-oriented approach that we're seeing now more than ever. So we want to talk a bit about how to prepare to identify your risks and build a robust program for responding to climate risks and managing these issues. So I'm going to kind of circle back a little bit to start, and I'll share, you know, what Sanduni already covered quickly in one slide. So we're really looking at scope 1, scope 2, and scope 3 emissions. We talk about scope 1 being the direct emissions. It's primarily combustion sources, not entirely, but that's the larger contributor for scope 1. Scope 2 is primarily the emissions associated with electricity consumption. It could be district heating and cooling as well, but that's sort of the main contributor there for scope 2. And then scope 3 is a broad array of life cycle emissions, upstream and downstream. And I guess at the outset, all I would say is, whereas in the past you may have been doing some GHG inventories and only focused on scope 1 and 2, that will change in the future as you need to make a climate neutral or net zero carbon commitment. Scope 3 will be part of that picture. And for those of you that have been maybe only subjected to EPA's mandatory reporting rule, remember that's just a slice of scope 1 emissions. It's not even the entire gamut of scope 1. So, you know, when you're doing the planning around GHG emissions management, it's all of scope 1, even some of the more incidental sources, as well as scope 2 and scope 3. So in terms of calculating and managing your emissions, there are several steps that represent good practice. I mean, it begins with establishing your baseline year, identifying the scopes that you're going to cover, and the sources related to those scopes of emissions. Moving on, you look at your various calculation methods, make sure you cover all appropriate greenhouse gas emissions, and identify the most relevant global warming potential so that you can calculate a CO2e or carbon dioxide equivalent emissions level. Then you move on to collect the relevant input data, perform your calculations, assess the hotspots or material contributors, and then roll up your results so that you can manage emissions effectively. So it begins with establishing a baseline year. You should be thinking about the reason for selecting your particular year. I mean, in the past, I've been with Trinity for 17 years, and even at the outset was helping clients with voluntary GHG inventories. A lot of clients had already established reduction targets that went into the future, even shorter time frame from where we are right now, and maybe their base year was 2002 or 3 or 5. You will need to be selecting something a little bit more recent, at least 2015 if you're going to be pursuing a net zero carbon target. But you want to think about, okay, what makes sense. You may want to be thinking about getting credit for some initiatives that you've already implemented in the last 5 to 7 years. That's the kind of thing that you would do at the outset. Then you want to think about having a baseline year emissions recalculation policy. So companies grow and change over time. You want to identify the way in which you're going to adjust your base year in accordance with what has happened from a business standpoint, mergers, acquisitions, divestments. There might be changes in emission calculation methodology, or you have better data in the future, so you want to adjust what happens in the past. You may even have a few errors that creep in, so you want to change things accordingly. And in general, the protocols that are governing, especially the GHG protocol, sort of the Bible of greenhouse gas emissions calculation, will require that you recalculate the baseline year when there's a significant change in the structure of the emissions inventory or the actual results. They're a little bit loose in terms of what constitutes significant. There's a little bit of flexibility there. I mean, in general, it's considered to be somewhere around 5 to 10%. There are some regulatory programs or platforms that actually stipulate what constitutes significant. I think the California Clean Action or Climate Action Registry says at 10%. So the idea is to just be monitoring that and change when things, or modify your inventory when things change significantly over time. Next step is to identify your sources. So it's all direct and indirect sources within your boundaries. I think it's to some extent straightforward, although for complex industries like chemical, it can be a little bit more involved. But it's basically your stationary combustion. That's going to most often be the lion's share of your emissions. You may also have mobile combustion sources as well. It could be your powered industrial trucks, even vehicles that you own that employees use. Process emissions can be part of it. I think about the chemical industry in general. There may not be a lot there as opposed to, say, the cement industry or iron and steel, but there could be process-based releases of greenhouse gas emissions, CO2, or it could be methane or something else. And then fugitive releases as well, which it could be from refrigeration systems, or there's certain industry sectors that will have sulfur hexafluoride. That's could be a fugitive release of a greenhouse gas pollutant. On to scope 2, as I mentioned before, largely purchase electricity, but it could also be district heating and cooling or steam. And then scope 3 is a whole host of upstream and downstream life cycle categories. But you need to be thinking about those, figuring out which ones are relevant and substantial, and quantifying what those are. When I look at the the calculation methods available and how one does an inventory, I would say this is probably what you might characterize as moderate technical complexity. So it's not like you're doing an extremely convoluted mass transfer set of calculations or mass balance. It's somewhat straightforward. Although I should say for certain industry sectors, it can be rather convoluted. I think those in the semiconductor industry might argue with me about mass balance being straightforward. Theirs is a very convoluted mass balance. But anyway, it's I think reasonably straightforward. There are emission factors available to calculate emissions, especially from combustion sources. You may have direct measurements of CO2 from combustion sources. In a lot of cases, mass balance is reasonably straightforward, especially for fugitive categories such as refrigerants, but you just need to pull all of that together and figure out the best approach for doing your calculations. There are sector tools available in some of these protocols that you can avail yourselves of as well. And even, a lot of companies will use the same methodology that they use for their 40 CFR Part 98 mandatory greenhouse gas reporting rule submittals. So, and I should say that, when you look at that, you might say, oh, there are a lot of different methodologies. I mean, they all basically align at the core. So even the mandatory reporting rule methodologies are very aligned with the GHG protocol with just some slight differentiation. Then you need to make sure that you're covering all of the relevant greenhouse gases. You may exclude a few if they are truly insignificant, but you need to look at all of these as listed on the slide. So it's definitely CO2, methane, and nitrous oxide are often very significant. If you've got refrigerant, a significant amount of refrigerant loss, that would be your fluorocarbons. Certain industries, maybe not so much chemical, but sulfur hexafluoride can be significant, or nitrogen trifluoride as well. And then you basically account for the emissions on a mass basis individually, separately, and then you apply the global warming potential to get to a CO2e carbon dioxide equivalent number. And that can be a little tricky too, because the IPCC tends to issue reports every 3, 4, 5 years and updates ever so slightly the GWP. So you want to make sure in general that you're using the latest global warming potential. I've listed a table here of some of the prominent pollutants and the relevant or applicable GWPs as stated in the second assessment report, the fourth and the fifth. You can see it changes ever so slightly. And I think it can get a little bit tricky when you are, say, doing both EPA mandatory reporting rule disclosure as well as voluntary disclosure. And the MRR rule says you need to use the second report, and then you're trying to do voluntary disclosure based on the most recent report. I think just make sure that in your inventory management plan, you are documenting what you're doing for which disclosure, and it's all clear, and then it shouldn't be a big issue. The next step, of course, is to collect the activity data. It's often, largely fuel consumption. It can be, your operating hours, your electricity consumption. Certain industries, it might be, the fugitive releases of like oil and gas, methane, and pipelines. So there might be leak monitoring data. So you just need to identify and document the input data sources and then follow that path each year as you update your inventory. So it's a combination of typically direct measurements, some engineering estimates, and some surrogate measures, some factors and so forth, as well as in some cases purchasing records if you're looking at mass balance. I think it's important to plan ahead because this does take some time in order to do it accurately. I think those of you that are, say, disclosing already to CDP, you're probably already nodding your head. You're saying, oh yeah, we start at the very beginning of the year because we need to pull together the information. We need to do our calculations. And you may also be having your inventory subjected to third-party verification review. So it can take a while. And typically, the disclosure timelines are in and around the summer months for, at least in my experience, that's a CDP deadline as well as sustainability report deadline. Then the fourth step, perform your calculations, assess materiality. And by that, we simply mean, you might find some sources that really don't contribute substantially to the inventory. And it's okay to document and then, exclude them for future calculations. It's not that useful to continually chase your tail to try to get information to do a calculation that results in 1.2 or 0.7% of the total profile. It's okay to actually exclude those types of emission sources, because I think it's helpful to keep in mind the end goal is to figure out what your footprint looks like and then target some practices or implement initiatives to reduce that footprint. No matter what, though, document what you're doing so that it's clear, what sources may have been put to the side or considered insignificant in the overall GHG emissions management process. Oh, one more thing I should say. We don't have time to delve into great detail here, but the scope 3 quantification is a challenge because it covers many different types of sources across the life cycle. There is a way to quickly assess what the contributions might be from the 15 categories of scope 3 emissions. There is a scope 3 evaluator tool that's provided by the World Business Council for Sustainable Development and World Resources Institute, which collaboratively have a scope 3 protocol. It's useful at the outset to use that tool to get a sense for what the larger contributors are among your scope 3 profile, and then from there, begin to do in subsequent years, for example, do your deeper dive to quantify. So the scope 3 evaluator tool is kind of an economic input-output model of life cycle quantification. So it takes kind of big picture business parameters to help you identify what those might be. And then you can kind of get into a more detailed engineering technical analysis once you figure out which categories are most important. In terms of the compilation, there are really two different approaches that are used. And actually, sometimes it's a combination. There's not any one absolute right way to do it. It kind of depends on your organization, how large it is. But basically, you can either go with an entirely centralized approach where individual sites just provide the data to the corporate entity, and the corporate entity takes on the challenge of doing the quantification. That has its pros and cons. Alternatively, you can go with a decentralized approach where you put the onus on individual sites to do an accurate job, provides that information to the corporate group, who then performs QA and rolls it all up. So it's really, it's not any one absolutely correct way to do it. It's just, I think it's a matter of thinking about the size of your organization and what makes most sense for you to efficiently gather the information and perform an effective quality assurance review. So in terms of best practice on the quantification side, a few key points to keep in mind are listed here. Definitely plan adequately for data collection and calculation needs, both internally and externally. You might need outside resources, or you might engage a third party for verification. It is extremely helpful to have a company-specific protocol to ensure consistency across the enterprise. And that's kind of, we kind of call it, your GHG inventory management plan. So it draws from all of the globally accepted protocols, but it's your personalized approach for calculating emissions, including how you gather together the data and which methodologies you use. At the outset, you want to look at all scopes and sources, at least initially, to figure out what you might include. You can exclude some things, but you want to start by casting the broad net. You want to also make sure you're integrating with existing systems, reporting programs, and tools to make sure that you minimize the burden, and again, report the same information across different disclosure platforms. Here's where having some type of either enterprise digital solution or internal homegrown digital solution is extremely helpful. We would say standardization is key to reducing risks of errors and inconsistencies. So have the same approach applied across your enterprise and make sure you're documenting. And I think if you have an inventory management plan, that'll be the platform for documentation. Before we move on to the reduction approaches one might follow, wanted to just talk briefly about GHG verification. It's becoming more and more common, particularly if you disclose to some type of public platform, such as CDP. So for example, CDP has a scoring system and it will award greater points for those entities that have had their inventories subjected to third-party verification. It's basically the notion of credibility. So greenhouse gas emissions are clearly becoming more material to many sectors. And the business community, the institutional investors are concerned about this information. Sanduni shared that background already. So it's almost like the emissions becoming, like financial data to a certain extent. So there needs to be a verification to ensure credibility of the information. There's a growing demand for reliable data, so that drives the importance of verification. And when you look at prominent carbon disclosure platforms such as CDP, they are all in terms of being committed to increasing the number of verified data submittals in its database. And as I said, they award greater point value for having your inventory verified. So what is it? But briefly, it's not just a quality assurance review. It's really systematic, independent, as I said, third-party process for evaluating the data against predefined criteria. And there are protocols for conducting verification. So if you do a GHG verification, you're using a protocol to conduct that verification. So it looks at the GHG assertion. So you're looking at the system or model that forms the basis of that assertion. How did the company pull together its information, ensure that it was accurate, and ensure that the results are spot on? And so you're looking at both the data provided as well as the systems, processes, and controls in place for collecting and managing it. So it's more than a QA review. It's a fairly detailed review, not just of the calculations, but also the input data and the source of that input data. It's like you would trace something, various bits of input data back to their respective sources. So taking CDP as an example and looking at their verification requirements, you can kind of see, the picture here. So it's you need to have an assurance statement, and CDP requires that be attached to the submittal. You clearly relate to what GHG emissions were covered, anything relevant about the profile that was evaluated. You look at what data has been verified, the relevant scope or scopes, often it's multiple scopes, the appropriate reporting year, the actual numbers, and so forth. Sometimes companies are having their greenhouse gas inventory verified as part of a broader sustainability report. That's fine from the standpoint of various carbon disclosure platforms such as CDP. They just basically say, attach the report then that covers maybe some other things besides the GHG verification to your submittal. So you can do multiple activities simultaneously. So let's move on then to the building the GHG and energy management program. Again, at a high level here. We have found that the best carbon energy strategies encompass several key elements. So it's really about governance to start out, then individual program components breaking down into specific action items or activities and initiatives, and then having all of that information be appropriately disclosed. So you need to have a policy in place, you need to establish metrics and goals, you need to have done a risk and opportunity evaluation at the top, that's sort of the governance part. You need to have solid program components, a good inventory, accounting and reporting program, identify applicable mitigation measures, and also have something in place for interacting with appropriate bodies on what the control measures might be, and then moving down, having kind of action items to reduce your footprint. When you're looking at developing a GHG and correspondingly energy target, there are several key steps. It starts with identifying the target type. A lot of companies will pick both absolute and intensity targets, sometimes one or the other. I would say kind of in this era where you're looking at these net zero carbon commitments or climate neutral commitments, it has to be an absolute target. But I think that some companies feel like it doesn't completely reflect what they're doing because they're growing and they know they're doing a good job of reducing emissions, but they show up as a higher profile because their business is growing. So that's where the intensity target comes into play. Of course, you need to identify your target boundaries, which greenhouse gas pollutants, what geographic boundaries, what sources. You want to choose a target base year, which I touched upon briefly just a few moments ago. And pretty much, if you're looking into the future and you're looking at things like net zero carbon commitments, it pretty much needs to be 2015 or later. And then you often will identify something aspirational well into the future, but commit to certain interim targets along the way. That's actually a good approach. So you have certainly a long-term target, but shorter-term targets as well. And it may be more than one shorter term. When you look at reducing your carbon footprint, and the second presentation in this webinar will cover these things in more detail, but it's basically kind of a combination of working towards having lower carbon fuel, implementing energy efficiency measures, deploying where you can renewable energy technologies, and then perhaps seeking out ways to reduce the residual emissions where you just can't do any more on your own. So that would be possibly looking at the purchase of renewable energy credits to kind of lower your scope 2 emissions or carbon offsets. And I've listed here some very useful websites to look at for some ideas. I know our second presentation is going to show some examples, but these are all really valuable websites. A lot of them are DOE sponsored. You also have the EPA Energy Star program, which is kind of a special designation you can get if you as a participant in a program, if you commit to reducing energy and GHG along the way. Any of those have a lot of great ideas, which I think kind of all fall into the category that what I just mentioned, the low carbon fuel, energy efficiency, renewable energy technology deployment. When you're analyzing your mitigation options, it's helpful to look at some key criteria. This is not required in any way by any protocol. This is just a suggestion. So you might want to look at implementation ease as one item. How difficult and potentially costly is implementing the action? Will there be internal or external opposition? What about the magnitude of the impact? Of course, what are the potential sustainability improvements from the action? How much will emissions or energy consumption be reduced? Are there any ancillary improvements that happen by implementing the action in mind, such as reduced water use? What about regulatory exposure? Will taking a certain action reduce potential future regulatory obligations under a cap and trade program, or help you with renewable portfolio standards, that type of thing? And then it is helpful to look at what your employees think as well as what stakeholders think. What are their perceptions? So that's a suggestion on criteria to implement when you're evaluating and trying to prioritize potential mitigation options. I think it's also helpful to look at what is this investment going to buy us? Because when you're implementing actions, it will cost something. The hope is, and in most instances, it actually is realized that you're going to reduce your operational costs, you're going to reduce liabilities, and that's a business benefit. So you want to look at what mitigation approaches are available. Obviously, you need to think about how much are we willing to spend, what's appropriate, what rates of return are desirable in your organization for carbon and energy mitigation projects. Do you get a little bit more leeway when you're implementing something that has associated benefits in the sustainability realm? In other words, it's not like a standard CapEx project where very rigorous criteria are applied. You need to think about that as an organization. Do we factor in, the larger scale benefit? Basically, how should these mitigation projects be evaluated? So to close things out, I wanted to talk about the interconnections between sustainability initiatives, carbon reduction initiatives, and things that you might already have in place, such as a management system. I've been working in the ISO management system realm for a long time. And I've really seen the at least potential interconnections between sustainability and just basic environmental management. And I think I actually had these recognitions prior to the latest version of the standard. But for those of you who know something about ISO 14000 or have implemented such a system, you will know that the latest version of the standard, the 2015 version of the ISO standard, had sustainability themes strewn throughout. So often when I am working with a client these days, I try to point out that you should draw the connections. You shouldn't have a separate program or path for EMS and another one for ESG or carbon management. They come together. And so I'm just sort of giving some examples. I'm not going to necessarily read through all the bullet points, but even at the top level of the standard, these are main areas of the standard. Context, that's really a materiality evaluation, which is an ESG sustainability thing. When you go down to planning and you're looking at your environmental interactions, the term is called aspects, you're supposed to be taking on a life cycle perspective. Well, that absolutely connects with the scope 3 quantification. And then the other part of planning is establishing environmental objectives. Well, GHG energy reduction targets are an environmental objective. So there should be those sorts of connections drawn in your system. Same, moving on to operation, having controls, operational controls or SOPs in place for mitigating your footprint. That's a great opportunity to connect your management system with what you're trying to do on the sustainability front. Not just for general purposes, but also for addressing change. You can put something in place, but then you have a change that happens at the organization and it might alter your emissions profile. Having a good management change program in place, as an example, allows you to maintain your footprint reduction activity. Performance evaluation, same thing. Key performance indicators that you would have in a management system go way beyond what's required under regulation. you should be including your sustainability reduction targets within the context of your management system. So really, that's kind of a sort of a closing point that we wanted to mention. There are strong interconnections, and if you have gone down the path of ISO or thinking about it, definitely leverage that to build your carbon energy management program, your climate change program. So that is it for Sanduni and Rich's side of the presentation. I think we have just a few moments for questions if we want to cover it at this time, or John, if you want to wait till later, that's fine with us as well. But we do thank you for the opportunity to talk with you today.
Yeah, thank you very much, Rich and Sanduni. We've had a couple questions come in, and I think in looking at them, why don't we just save those to the end? We'll go ahead with our break.
Yeah, that makes sense.
So we're going to come back in about 5 minutes, so a little bit after 11. So take about a 5-minute break from now. We're going to have Mike come on and show about some of the decarbonization options. There will be a little bit of overlap, and then we'll have wrap up at the end and the ability to get to any of the questions and wrap up among all our presenters. So thank you very much, and we'll see you back here in 5 minutes.
Okay, I'll stop sharing my screen.
All right, everybody, welcome back. Thanks again for hanging with us. Some great content covered in the first part of our presentation about carbon quantification, verification, reporting, things of that nature. Now we want to turn it over to Mike Trubus, again with Foresight Management. He's going to touch on a little bit of those topics, but really focus in on your options for decarbonization. So what can you actually do about it to make progress in this area? And he's got a lot of experience working in the Michigan market, and is going to touch on Michigan as well as Ohio facilities and what they can do in some of the general options, as well as our specific context here. Comes very well qualified and does a lot of work in this area, and we're very glad to have Mike join us and present today. So take it away.
Thanks for the kind words, John, and good morning, everybody. Like John said, I'll be taking you through my presentation here, if I can get the slides to advance. Okay, so quick outline, exactly like John said, we're going to focus just a bit of a recap briefly on what the Trinity folks talked about before, and then we're going to talk about what is net zero, and then basically how do you do it. So energy efficiency and energy and carbon offsets are really going to be the meat and the potatoes of the presentation. So just quickly about Foresight, you can think of us as outsourced energy and sustainability managers. Most of our clients either have one energy or sustainability person and they need extra capacity. However, many of our clients, especially the smaller ones, don't have a sustainability person or an energy person. We basically function as that on their team if they can't justify a full-time person. And that's ultimately why we have some good insights on what industrial manufacturing companies are doing, and especially chemical companies. So you can see here on this list, most of our clients are industrial manufacturing. That's typically Foresight's focus. Chemical fits square in industrial manufacturing, and we work with a bunch of different chemical companies, but probably the one that comes to mind first would be like S&F. But again, we have a handful of other chemistry-related clients. So again, I'm excited to talk to you a little bit more about the energy and sustainability piece. So let's recap a couple things. I think that the Trinity folks did a great job talking about the shift from shareholder economy to stakeholder economy. That's a big driver of why sustainability is happening. And I just want to take a minute to just refresh you. This is why we're seeing this big press for sustainability. And I know Sandwin and Rich spent a lot of time telling you, like, here's the nuts and bolts of how to report and why and what's going on with reporting. But it's good to take a step back and realize for a number of decades, companies were first cared about their shareholders and then second about everybody else. And now we're really moving into a full stakeholder economy where you have the Great Resignation and people have to consider their employees, and you have supply chains in shambles. And so there's more to consider than just, can I cut costs by offshoring jobs? So that's one piece. The other piece, and this goes along with the beginning of their presentation on the SEC, and that is just, if you're a publicly traded company, you're feeling incredible pressure right now to be able to report your carbon emissions and talk about sustainability in an intelligent way. And what we're finding, if you look at this slide, is most of the top of the food chain manufacturing companies, so think the OEMs for automotive, aerospace, even consumer goods, et cetera, are all making these goals. And most of these companies are publicly traded. General Motors, Steelcase, Walmart, you can see are all public companies that, since they're feeling that pressure, are saying our supply chain, we need to bring our supply chain with us. And actually, I was on a General Motors presentation late last year, and they basically said that for every ton of carbon that they emit, their supply chain emits 11. And you as chemical manufacturers, you fit in that supply chain of General Motors and of all these other companies that making goods, you supply them the underlying chemicals that they need. And so this is another slide that's exactly the same as the one that Sanduine took you guys through earlier, but it's basically, again, just reiterating, when General Motors says they're going carbon neutral by 2040, they need their whole supply chain to do it as well. They could go carbon neutral tomorrow, and that would only account for that 9%. Again, 1 out of 11 tons. They could get rid of that 1 ton, but they still need to get the 11 down in the supply chain figured out. And that's where all of you come in. And that's why we're talking about this today. And again, so that was just my brief refresher. And so there's 2 options. You can basically say, I'm a chemical company, I'm way down in the supply chain, and I'm just going to ignore this. Or you can say, this is an opportunity for me to grow my business. This isn't just an exercise in reducing costs. We're certainly going to talk a ton about cost reduction in the next 30 minutes. However, this is actually also an opportunity to grow your business. A lot of our clients that have really gobbled up market share over the last few years have said, what are my largest clients' goals, and how do we make our company align with those goals? So that's the running dog here versus burying your head in the sand. All right, well, if you're onto this vision, that's great. If you're not onto this vision, that's also fine. You can get a lot of cost savings associated with doing these things as well. So let's first talk about big picture. How do we think strategically about investing in sustainability? And I would argue it's this circle. Any of you who've done Six Sigma Kaizen stuff would be used to the plan, do, act approach, establish a baseline, identify opportunities to do better, design a solution, implement the solution. That's where a lot of organizations stop. And so we always encourage the measure and verify piece. A great story on this is we measure and verify for a lot of our clients. One of them bought a big LED project in their warehouse, and we're looking at their energy usage and saying, hey guys, your electricity consumption didn't go down after this lighting project. It should have. And they said, huh. And they went back to their building and found out that when the LEDs got put in, the occupancy sensors never got commissioned. And so the lights were running 24/7, eating up all their savings. So sure enough, they went back to the electrical contractor, had them commission the occupancy sensors correctly. Boom. Their savings showed up the next month. So it's very important, if you're going to spend all this time setting a baseline, identifying, designing, and implementing, you got to make sure that you get the savings. And far too many organizations kind of skip that phase. And then the celebrate piece, we're going to get into a little bit more later, but I think a lot of industrial clients don't quite understand that telling your story is important. And yeah, you may not be a business to consumer business, you're a business to business company, but you really, there's a lot of value, I think, in telling your story, especially to your customers, so that you can help them understand why you're more compelling. I think too many companies these days only compete on price. Frankly, there's a lot of other things you can compete on as well as price. Okay, so now we're going to talk about the strategy, and we're going to get into the meat and potatoes. I know that the Trinity folks touched on this, and I'm just going to highlight this, but the first thing, fundamental, ground zero, if you want to do anything around a sustainability plan, you got to address your corporation's mission, vision, and values and engage leadership. Far too many organizations, we interact with somebody, they're very down in the totem pole. They really are passionate about this, which is great, but they have no buy-in from leadership. And so frankly, it just doesn't go anywhere. If you want your organization to make meaningful progress on this, it has to either come from the top or have real buy-in from the top. And the way we recommend doing that, and Rick talked about this a little bit, which is doing a materiality study. So basically saying, what is important to our stakeholders? What is our mission, vision, and values? And how do we plug in sustainability into that? We're not asking you to blow up how you do business. We're not asking you to blow up how your company functions. This is more of a tweaking, basically saying, what is my lens around energy and sustainability? And how does that fit into our existing mission, vision, values, and strategy? So again, this doesn't have to be wildly disruptive, but if you get this piece right, the rest of it flows very nicely. Okay, and then this is something that the Trinity folks talked about a ton as well, and that is data. You can't manage what you don't measure. if you're trying to lose weight and you never look at nutrition facts and you don't own a scale, I'm going to go out on a limb and say you're probably not going to have much success losing weight because you don't have the data and you don't have the information that you need. And in sustainability journeys function the same way. Once you have alignment with leadership, the next thing you got to do is start looking at what kind of data points do I need to collect? What type of data points are material to my clients and my customers? And what do they care about? And what do we care about as an organization? If you're not managing it, if you're not measuring it, you're not managing it. And a couple just highlights on this to Michigan and Ohio customers. There's a lot of value in collecting this data beyond sustainability, especially the two, if you look at the bottom metrics, energy and waste, we find so much extra cost on people's energy and waste bills. They sit there and think, oh, this is overhead cost. We got an electric bill, we got to pay it or they're going to turn out the lights. No, there's a ton of opportunities to reduce your electric costs. In Ohio, energy is deregulated. You can make sure that you're buying it on a better contract. In Michigan and Ohio, there's sales tax exemptions on manufacturing. That would absolutely count for chemistry and chemical companies. So I cannot underline this enough. If you're a chemical company, you should not be paying the full sales tax on your electric and gas bills. Check that out. If you have any questions, obviously reach out to me. But that's, I mean, we get our clients in both in Michigan and Ohio. We've gotten our clients 6-figure refunds. We have a pharmaceutical company. We got them a $750,000 refund for overpaid sales tax. So this is a real thing, and these are real dollars. So again, not only is this building your sustainability plan, this is also reducing your costs. All right, here it is. So we got a buy-in from leadership. We have good metrics that we can work off of, and we set the plan that all the Trinity folks were talking about. What do? We want to get to net zero maybe. Let's say we're aligning with some of our clients and our clients have this net zero. How does this work? You might be saying, Mike, I run a chemical company. I have to use a lot of heat to make my chemicals. I can't just use no energy. It's physically impossible. You're right, it is physically impossible. So we basically say there's two approaches to this. We have your energy. There's basically two things you can do. You can invest in energy efficiency, which we're going to talk about first, and that'll lower your energy. We're going to drop it down by investing in a bunch of these energy efficiency opportunities. Once you've squeezed your energy as much as possible, that's the smart first step. Then you need to buy renewables, buy offsets, and basically lift the bar with all green energy and carbon offsets to get you to zero. Some companies think they can just buy their way out of this hole. The short answer is you can, but it's not going to be it's not a very effective long-term strategy. Other people think all I'm going to do is squeeze as much as I can and ignore the other half. And again, the winning strategy is squeeze and then offset. And we're going to cover both of those in big detail here. That's really the meat of my presentation. So the first thing, like we said, let's start doing some squeezing. Where you might wonder, where on earth can I do some squeezing? The big ones are lighting, compressed air, controls, heating and cooling, pumps, and demand management. We're going to cover some of these in a lot more detail. But the big picture thing to say is energy efficiency is very lucrative from a cost standpoint. Most of the projects I'm going to talk to you about pay back in under 5 years. Many of them pay back in under 2 years, and some even pay back in under a year. I mean, these are things that a lot of our clients are saying, this is very lucrative for our business. We are meaningfully reducing our operating costs. The other thing you might say is, well, is this really going to move the needle meaningfully? I'll admit chemical companies typically are more energy intense than your average manufacturer, but there are still opportunities to reduce as much as 35% of your energy consumption if you're investing truly in all the energy efficiency opportunities you have. So think about that. You could take a 35% bite out of your electric bill and gas bill, and then frankly, you can take a 35% bite out of your carbon emissions. Is that true for every single factory? Maybe not, but for many of them, that is real, the amount of savings we can get. All right, so let's start. Almost every other presentation I give when I'm talking to other manufacturers, I don't start here. However, as a chemical company, you very likely have extremely high energy inputs and costs associated with heating things and cooling things. This is very true for almost all our chemical clients. They spend a disproportionately high amount of energy on heating, cooling, and pumping. You guys just have a bunch of pipes everywhere. You guys got a bunch of heating and cooling. And so let's start there. Big project that you should absolutely be doing, don't even think about it, is tuning up your boilers when you're getting your CSD1s and tuning up your chillers. This stuff should be done annually, semi-annually at the worst. It's typically a 1-year payback or less. Again, this is just ongoing things. You might not realize this, but when you do a boiler tune-up, you can increase your efficiency by 1%. You might say, Mike, 1%, that's nothing. Well, the reality is a lot of chemical clients that we know of, their boilers are consuming, let's say, $500,000 in natural gas a year. That's not uncommon for a boiler system. That's $5,000 a year that you're saving right there, just in tuning up your boiler at 1%. So it adds up. It's a meaningful savings. The other thing is insulation. This is, again, so often overlooked. People put in their insulation when they put in their boiler system in the 70s at their factory, and they say, yeah, it's great. It's been there. We have our pipes insulated. But the reality is, like everything else, insulation wears out. So you want to make sure that you're doing that. A lot of times we're going through our clients' chemical factories with a thermal imaging gun. I don't know if you guys have seen those things, but it's a camera, it's infrared, and it can basically see where energy and heat is being leaked. And that's always a good best practice to go look at the piping and make sure that it's all appropriately insulated, so you're not wasting all that steam or hot water or chilled refrigerant that you've generated. And then heat recovery is a huge piece. Don't waste the heat that you have. We have a big chemical client who, and this is actually more food than anything, but they have a big steam system. Most of the steam that they use is consumed in their process. And so then they have to make new steam, and they were using 50-degree city water and boiling it all the way up to 212. Well, what they didn't realize is, what they realized is, well, hey, we're also cooling a bunch of things, and we have a number of cooling towers and other chilling units. And so what they said is, let's take the heat that we're rejecting outside and reject it into a heat exchanger. And so sure enough, that's what they did. And they ran the heat from their cooling system into a heat exchanger, and they ran the city water through it. And the city water went from 50 degrees all the way up to 120 degrees. So they got 70 free degrees worth of heating, and then they sent it into the boiler. I mean, it doesn't take a rocket scientist to know that the amount of energy it takes a boiler to boil water from 50 degrees is a lot more energy than it takes to boil it from 120 degrees. So there's a ton of these opportunities. If you're smart, you got a lot of heat rattling around in your building. You got a lot of cooling and rejected heat in that case, also rattling around in your building. How can you be more efficient about it? And then the last bullet point is actually probably the one where you actually will have to have a longer ROI, but it's worth looking at end of life. And that is, chillers and boilers just naturally have gotten more efficient over the last 1, 2, and 3 decades. If this stuff fails, don't replace it like for like. Make sure that you're getting something that's more efficient. And actually, while we're on the heating piece, cogen is a phenomenal application in many cases for chemical companies. So cogeneration, or combined heat and power, is basically the concept of instead of just having a steam boiler, you have a steam boiler that you then run that steam through a turbine, and you generate electricity too. So basically, you're making steam and you're getting a byproduct of electricity as opposed to just making steam. And these things are crazy thermally efficient, which ultimately results in crazy efficiency. So a lot of our clients use marginally more gas with a CHP system, but then they get a bunch of free electricity. So you might be saying, Mike, is this real? Is this a viable technology? The short answer is, if you need steam heat 24/7 or close to it, and you have high electricity prices, this is generally a very viable option. We have a client there in the box manufacturing world. They have a corrugator. They spend, we did a CHP analysis for them because they run the corrugator and it needs steam 24/7. Basically, they were looking at basically about $1 million in capital. So this is not a small capital project, but their savings were $500,000 a year. It's pretty significant. That's a 2-year ROI. And again, they basically took something like 8% of their electricity just off the grid at this point. And so this can be very, very viable. The last bullet point I'll highlight, and if any of you want to reach out and understand how you can get this, the Department of Energy offers free feasibility studies for cogen. So you don't have to even get sold at. This is done by the Department of Energy with your tax dollars. So again, reach out to me. I can get you hooked up with those people. They do a nice job, and it helps you just understand, is this a real viable technology at my factory, at my chemical plant, or not? Okay, so that heating and cooling, again, is a massive energy pit for chemical companies, but compressed air typically is as well. Oh my goodness, this is probably the best ROI projects we see for our clients is investing in compressed air. So much compressed air gets wasted and leaks. Most facilities are leaking 20 to 40% of their compressed air, just blowing money out the pipes, just like you see in the picture. This is something that you should consider as ongoing maintenance. So what I would say is you should be fixing your leaks annually. If you're a Michigan chemical company, I have great news for you. Consumers and DTE and the other electric utilities offer generous incentives for doing a compressor leak study. So in many cases, we're going in that you need to have a third party do it. We're going in for our clients, we're doing the compressor leak study, and consumers and DTE are paying 100% of our costs to do the work. Sometimes we're even fixing the leaks for you. So this is free money. And in a lot of cases, not only do you not pay anything, savings can be $20,000, $50,000, $75,000 a year in compressed air. So this is something you should absolutely do. Unfortunately, my Ohio friends, your legislature does not do utility incentives, so you wouldn't have to do it. But again, if you think about the cost of a compressor leak study, it could be $5,000, $10,000, $15,000 to get $50,000, $60,000, $70,000 a year in cost mitigation. This is a payback on the order of months. This is good preventative maintenance. This is something you should incorporate into your plan. Many of our clients that have the best energy management and carbon reduction plans are doing this frequently. But it's beyond leaks. There's actually compressor consideration. So VFD, or variable frequency drive compressors, are the new technology. They basically can move up and down based on how much energy you need. And we're going to talk about VFDs a little bit later with pumps too. But basically you think of them as dimmer switches for a motor, just like you have dimmer switches for your light that you can turn the light up and down. And this is an incredible amount of savings. If you don't have a VFD at your facility and you're using a lot of compressed air, it's probably going to be a 1 to 2 year payback to get one. Again, you Michigan companies, you're going to get a really nice generous incentive from your utility supplier as well to help pay for that. So it's really good. And then just making sure that you have a good plan around controlling your compressed air. I'll just say it one last time, but far too many companies overlook this. It's part of your electric bill. You don't have good granularity into it, but this is a very, very cost-effective way to reduce your carbon footprint and frankly, just save a lot of money. And chemical companies can be a little bit of an outlier, but for most industrial manufacturers, their single largest electric consumption is compressed air. So again, important to have a focus on. Lighting. All right, you guys are probably rolling your eyes at this because 1 million people have door knocked you in the last 3 years slinging LED lights. And you're not wrong. It is kind of eye-rolly and there's a lot of people slinging lighting. However, lighting is a viable technology. There's a reason why so many people are selling it. It's because it's compelling. LEDs, if you look at the chart on the right-hand side, if you look at that blue line, that's the improvement in efficiency of LED lighting. It's basically now double the efficiency of any other technology on the market, which means you can use significantly less. At the beginning of the LED revolution, chemical companies were largely overlooked. And the reason why is many of you chemical companies need either IP65 light fixtures or explosion-proof light fixtures, and they didn't really make those in LED. However, in the last 3 years or so, there are very viable explosion-proof options for LED. There are very viable IP65, IP66 rated fixtures as well. So this is something that if you haven't done yet, if you're on the really old metal halide or even fluorescent, the payback is insane. Typically under 2 years if you're running 24/7. And the other nice benefit is it's a lot of maintenance to change old lamps. The LED fixtures have significantly longer rated life. So you get the cost savings and you get the benefit. If you don't want to deal with people door knocking you to death, we can obviously help as well and help you solicit reputable suppliers because frankly, it is still the wild, wild west with some people out there just slinging. So just make sure that the company you're working with is reputable, has been around, and then absolutely make sure if they're claiming whatever, an insane warranty, I'll give you a 10-year, 15-year warranty. How long has that LED manufacturer been in business? A warranty is only as good as the company that stands behind it. So that's a big thing I would recommend is making sure that you understand, is this a reputable lighting manufacturer? Have they been in business for a while? Is this something that's going to work? And then the bottom bullet point, the financial piece can be really lucrative for doing lighting. There's, again, utility incentives if you're in Michigan, but even if you're in Ohio, if you're not, the federal government offers a 179D tax deduction for doing lighting that can pay for anywhere between 10 and 30% of the cost. So again, if you're in Michigan, you can get almost half your lighting project paid for between utility incentives and the 179D incentive. So again, I think the entire society understands LED lights are brighter, they last longer, they use less energy. This is something we all need to be investing in as soon as possible. And it really is benefiting our society that LEDs have been so widely adopted. Okay, last thing on the energy efficiency piece, like I mentioned, pumping is a big deal at most chemical factories. This is wild. When I learned about this is an interesting statistic, but if you think about this, this is why it's so important to buy a pump right. Think about this in your mind. If you bought a $50,000 motor, and I know that's a pretty extreme example, but if you bought a $50,000 motor, how much do you think it'll cost to run that motor for its lifetime? Just think of a number in your head. $50,000 motor, how much energy will it consume over its lifetime? The answer is $1 million. So when you think about buying a motor, 5%, this is the statistic that blows a lot of people's mind. 5% of the dollars you spend on of the total cost of the lifetime cost of the motor, 5% of it is spent on the purchase, and 95% of it is spent on the operation and maintenance of the motor. So do not buy the cheapest motor. I'll say it 1,000 times to 1,000 purchasing people, but it's like you are stepping over dollars to pick up pennies. Yeah, you may have saved by buying the cheapest, least efficient motor, but the reality is the energy consumed by the motor is an order of magnitude larger than the cost of the motor. So think about that. That is a huge consideration. We typically recommend if you have a motor that's failed, you want to buy the most efficient motor you can find that's still reliable and meets your needs. That's an extremely important consideration and something to not take lightly, because again, there's a lot of motor and pump energy consumed at a chemical facility. The other thing I always say is if you just keep rebuilding your motor, each time you rebuild it, it gets a little less efficient. At some point, there is actually value. And again, buying a new high efficiency motor instead of just rebuilding it for the 8th time, because again, you're just spending so much energy, so much money on energy. It's actually a very lucrative financial payback to just buy the more efficient motor. And then the last thing we talked about is VFDs. We talked about them with air compression because there's variability in your air needs in your plant. It's good to be able to turn that up and down. It's the same concept with motors and pumps. I'm sure many of you have VFDs in your factories. Anything you can put on one, anything that's variable, it's a huge benefit. You reduce your power factor penalties, you save energy, you actually extend the life of your motor. Again, it's back to a win-win-win. These are things that if you are going to operate your facility excellently, this is stuff you should do. And again, all of this stuff that I just talked about not only saves you a lot of energy and money, but this is the fundamental base of building your carbon reduction strategy. Investing in your heating and cooling, your lighting, your compressed air, and your pumps. Let me pause a second here. I already talked about this graphic, and we just covered the entire piece on investing in energy management. We just squeezed as much as we could out of our facility. So now let's change gears a second and talk about what are our options to increase our renewable energy and our offsets. How do we basically get to that last piece of net zero if we're trying to align with our clients? I'm going to talk carbon first, because frankly, it's messier than renewable energy. I don't know how to say this softly, so I'm just going to say this pretty bluntly. The carbon markets are still pretty immature, and there's still a lot of struggling with carbon offsets being double counted. And so this is something a lot of our clients are wading into slowly with small investments and making sure that they really understand what they're buying. We are always cautious to make sure that you're not buying offsets that have already been sold again. And we'll talk about this on the renewable energy side, and that there's a lot more robust systems in place. But frankly, on the carbon side, there's a big struggle with double counting. So you have to be very careful when you're buying carbon offsets. If you did want to buy carbon offsets, just to give you guys some concept, I wanted you guys to have some budgets. What should I plan on investing if I have to do this? Common carbon offsets. So an offset basically is saying I'm emitting carbon and I want something else somewhere else that is not emitting carbon. Tree planting is a great example, or other companies doing efficiency projects. Those are good examples of that. Your price per ton of carbon removed is $5 to $50. Depends on how robust it is, how legitimate it is, how much certification is associated. But that's your budget. So for every ton of carbon you emit, it's going to cost you $5 to $50. If you want to put a price on carbon internally, I'd probably land it somewhere in that range. Okay, so let's talk about the next step. And this is stuff, frankly, no chemical company is doing. You don't have to worry about this. I just want you to have some context on what you're hearing is a lot of these fancy tech companies. So Stripe and Google and Facebook and Amazon, when they're talking about carbon sequestration. And that means they're actually literally physically pulling carbon out of the air and putting it somewhere where it can't get back out. So that sometimes is pumping it underground. There's a bunch of other technologies. That is significantly more expensive. And again, that is not something most chemical companies are investing in, but I want you to understand that it exists. It's very new. It's a very new technology and something that you should just know exists, but not necessarily that you need to invest in. If you want to sequester carbon, you're probably looking at a budget between $1,000 and $10,000 per ton. So this is orders and orders of magnitude higher than an offset. But that is the difference between the two. And as you wade out into these markets, those are the considerations. You're likely going to want to start with offsets, but you're going to want to find high quality, verifiable offsets. So that's carbon. And carbon, back to what the Trinity folks were talking about, carbon offsets are typically used for your scope 2 emissions, your scope 1 emissions, which are your combustion, natural gas, diesel fuels, propanes, et cetera. That would be offset with carbon offsets and sequestration. However, your scope 2 emissions are electricity. And this is a very robust marketplace. There's going to be a couple slides after this that have a lot of detail. So the nice part is John is going to send you all this presentation. So I'm not going to spend a ton of time going over all this detail. And this is a lot of words in the next couple slides. So I'm going to just talk through it and then you'll have a little bit more detail if you need it. But basically, if you want to green up your electricity, go 100% renewable energy, the fun and good news is you have a lot of options at your disposal. And these options can actually vary a little bit between Ohio and Michigan. And I got good news for you, Ohio. After all the bad news about incentives, Ohio's deregulated for electricity. So you have a lot more options for buying renewable energy than your chemical friends up in Michigan. So the sword cuts both ways depending on how regulation exists in the two states. So let's talk about it. What are our options and what do they mean and what's going on here? So starting from the top, which is probably the easiest, lowest cost, lowest risk. Sorry, my apologies. I just clicked back here. Is RECs, which is renewable energy credits, then green tariffs and green rates. We have virtual power purchase agreements and power purchase agreements, which I'll use the acronym VPPA and PPA. And then the last is on-site generation. I'm literally putting solar panels on my roof. So we have shades of green here and we have some bullet points. And I think some of these bullet points are pretty explanatory, but the one that you might be wondering, Mike, what are you talking about, is the last bullet point for each, which says the word additionality. You might be saying, Mike, what is additionality? Additionality answers the question, does my purchase add renewables to the electric grid? If the answer is not really, then that's a little additionality. If the answer is yes, then there's quite a bit of additionality. So again, think about it. You put solar panels on your roof, it's total additionality. You have added more assets to the grid. If you are buying RECs from an asset that already exists, you're not really directly adding anything else. That asset already exists. You're supporting the market, but you're not actually adding anything new. And so that's the nuance here between things. And that's why you see those shades of green. So basically, if you want to get started on your electricity offset journey, RECs is a great place to start. They're low cost, they're inexpensive, and they're flexible. So we'll actually jump into the details really quickly. RECs are cheap, frankly. You're talking about $5 a megawatt hour when your electricity out the door probably costs you somewhere in the neighborhood of 100. So if you wanted right now to go 100% carbon neutral on your electricity, 100% green electricity, take your entire electric budget, take 5% of that, and you could probably do that today. Is that the best long-term strategy? Again, probably not, but you might be surprised. It's really not as expensive as you think. When I tell a lot of my clients, if you want to go 100% renewable electricity today, you can do it with RECs. You can do it really easy. You can sign a 1-year contract and it can get done. But again, the additionality is pretty minimal and a lot of organizations are moving past RECs and into more robust things. So the green tariffs and rates piece, green tariffs in Michigan are not very viable. So consumers and DTE and the other big electric utilities, that part of their rate is not regulated. So they'll say, hey, we'll give you green electricity, but they're typically charging you 2 to 3 times what RECs cost for RECs. So I would recommend if you're in Michigan, probably don't buy consumers or DTE or your municipal electric's green tariff. It's probably more cost effective for you to go buy RECs. And if you're in Ohio, this is where it gets fun. Ohio's deregulated. You can buy electricity from suppliers. And those different suppliers, a lot of them have renewable electricity products that include the power and the REC, the renewable energy credit, that's involved with that megawatt hour of electricity. These frankly aren't all that much more expensive. Again, they might only be 2 to 5% more expensive than the brown power option. This is a great option for you to go renewable energy, bundle it all together. In many cases, you can buy the RECs from the same asset that generated the energy, and those are considered really nice. You have what's called a bundled REC or a bundled product. And the market really smiles on that. People think that's really cool when you're able to do that. And you actually have the privilege of shopping and doing that in Ohio. So I would encourage you all in Ohio, take advantage of that. In Michigan, your green tariffs are probably not that viable. And then let's talk VPPAs and PPAs. And then we're here at the end. So PPAs and VPPAs can get really crazy. You have to be a massive user for them to be viable. So I'm going to probably just say likely not relevant. And then on-site generation, that's putting solar panels on your roof. Couple considerations. You should do this with new construction or when you're replacing your roof. A solar system lasts about 25 years and a new roof lasts about 25 years. So you don't want to put a brand new solar panels on a 20-year-old roof. You're just asking for trouble. So that's like the big logistics piece. There's also a lot of benefits to doing solar on your roof. You get a 26% tax credit that really juices your ROI. It is a decent amount of capital outlay, but it can be really viable. And in many cases, it is only a 5 to 7 year return on your investment. And the solar system lasts 25 years. So you get your money back 4 times over what you invested in it. And if you have a lot of taxes, you can reduce your tax burden. So those are some of the considerations of solar. Again, there's a lot of companies out there slinging solar. A lot of solar companies will say you don't pay anything and we'll just sell you electricity at a fixed price. That's what's called an on-site power purchase agreement. Those can be really nice. Again, please proceed with caution. You're going to want to understand what you're signing. And so it can be beneficial to have an unbiased consultant like us review those contracts. We've run into companies that signed a PPA 5 years ago before we were doing business with them. They want to claim those savings. And sure enough, when we look in the contract, they gave the RECs, the renewable energy credits, to the PPA supplier. And so they can't claim the attributes. They can't use them. They can't claim them as part of their contract. They didn't realize they were signing those away. So just be careful what you're signing and make sure that you know what you're signing up for when it comes to solar. There's a lot of really reputable solar companies, but unfortunately there's a handful that aren't either. So just be careful. Okay, and then I'm going to finish on telling your story. This was covered a little bit by the Trinity folks, but if you implement the strategy that I just laid out of getting buy-in, measuring and managing what you're doing, implementing all these really cool projects that make you operationally excellent, the best thing you can do is go out and tell that story. Tell that story to your employees. They want to work at a company that's forward thinking and has a vision for the future. Tell that story to your stakeholders, like your customers. Make sure they understand, hey, I'm aligning with you. You need to do more business with us because we're going to help you achieve the goals that you're looking for. This is not just a battle on price. We certainly can give you a good price and we certainly can deliver you what you need in a timely fashion, but we're also helping you achieve your goals. And then shareholders, if you're a public company, this is a huge drive. We just talked about this for 2 hours. The public markets love companies that are able to quantify and tell this story. So if you're putting in all the work that I just talked about over the last half hour, do not stop there. Make sure that you're telling the story. It's not bragging. It's helping people understand what it means to be a forward-looking company in 2022. And that's basically what I just wanted to say here, which is this is not an exercise in reducing cost only. It is an exercise in reducing cost, but also helping you become more marketable and understand and helping you explain to your clients why you're the better option than your competitors, because you're aligning with their goals and offering a cost competitive product in a timely fashion. Okay, that's all I have. We can jump in, John, to some questions for either us or our Trinity colleagues.
Great, thanks, Mike. That's awesome content. I'm really excited by what we've heard today. Hopefully it's been useful to all of our attendees. We do have a number of questions that have come in through the queue and some that submitted ahead of time. So one of the first questions, just very general, either for Mike or for Richard Sanduni. how have you just seen clients encounter this, whether it be from their customers? How are they getting, I guess, dragged into this by the value chain?
Yeah, I guess I'm off mute, so I can jump in. The biggest thing is exactly like you said, it's their customers, so a lot of OEM, top of the food chain companies, and how they're getting engaged is through customer requests. So a lot of times that's a spreadsheet. So that's somebody saying, hey, we need you to fill out this spreadsheet for water consumption, energy consumption, carbon emissions, safety incidents, whatever it is. Each supplier usually wants different metrics, so it can get really messy really quickly. But that's where a lot of companies come to us and say, hey, Mike, we need help. Like, we're getting asked to report on this stuff, and some of this we can, and some of this we have no idea. So that's one piece. The other piece that Sanduni, you can probably talk to more, is the standardized platform. So things like CDP, which they mentioned, or there's standardized platforms where suppliers are saying, instead of us making you fill out a spreadsheet, we're going to align with EcoVadis or CDP. You need to fill out your information to them. They're going to score it, and we're going to look at that. And I don't know, Sandrine, if you want to expound on that at all, but those are the two ways we typically see people engage.
Yeah, just want to second what Mike said. I agree. Especially for CDP requests, we're seeing more and more of that coming in. And even if it's just one major client that you're serving, if they're requesting a CDP questionnaire be completed, you'll probably want to submit that information. So we are seeing a lot of that, where even if it's just one customer that's requesting that data, companies are starting to respond to those requests.
Yeah, let me also jump in and reinforce both comments here. So CDP is a very, very prominent global carbon disclosure platform, and the introduction of their supply chain program about 10 or 12 years ago has resulted in an enormous increase in the number of respondents on an annual basis. So as a quick example, when I joined Trinity in 2005, in the first few years when we were helping companies with CDP disclosure, the numbers in total were in the hundreds, like maybe 400, 500, 600 companies total globally disclosing. By the time they established their supply chain program, which are large multinational companies with enormous value chains, who then turned to their to their suppliers and said, we want this information, we want you to disclose this information on CDP's platform. That created an enormous change in landscape, to the point where now, last year, there were 10,000 companies disclosing globally. So that's a pretty big deal. So that's made a giant impact. A lot of the companies that we help with CDP disclosure are also receiving the miscellaneous requests that Mike mentioned. They have to address both. They're trying to figure a way to consolidate it and make it more efficient, but it comes from key customers, basically. And there's also the institutional investor component there. That has driven this initiative, to an incredible extent in the last decade.
Yeah, I think one topic that we could probably spend a whole other 2 hours on is just Scope 3 emissions. So again, we talked about a little bit what Scope 3 emissions are. Hopefully you have a basic understanding of what that means, but especially for chemical companies in the value chain, I think this is very significant. So one of the first questions then is on the SEC rule and just how Scope 3 emissions might play into those federally mandated reporting. And then we can go from there with a couple of questions about how that might apply. So Richard Sanduni, you want to take that first part about the new rule potentially?
Yes, Sanduni, you want to start with the SEC requirements?
The SEC requirement, yes. So Scope 1 and Scope 2 will definitely need to be disclosed. But for Scope 3 emissions, it would depend if the Scope 3 emissions are material to the company, or if you have set a greenhouse gas target or a goal that includes Scope 3 emissions, then you will be required to report your Scope 3 emission total. So there's a bit of an exception there compared to Scope 1 and Scope 2.
So, but I would say that the bottom line is that SEC requirements are requiring some level of Scope 3 emissions, and they talk about doing it based on a relevance determination, to concluding which ones are material. there's a little bit of ambiguity there, but there is a process or protocol for doing so. So, for example, the World Business Council for Sustainable Development has a Scope 3 protocol, which includes a process for determining relevance. So that's something that CDP points to and actually asks for an evaluation on in the response to their questionnaire. So it does bring you through the process of looking at all 15 categories and making a determination as to whether that category is relevant. So, the short answer would be you're highly likely to need to characterize Scope 3 emissions for at least some of the categories. And that'll be required for SEC. It is already required for CDP, or required at least in terms of there's an expectation there, and if you don't meet that expectation, you will not be considered to have a robust response. It would be a lowest scoring response.
So
I do want to add, oh, sorry, go ahead.
I would say some nuance here too. So for those of you who are new to Scope 3, reporting Scope 3 is a very nebulous thing to say. There's significant variance in granularity of your Scope 3 reporting. And so I just want to encourage you, don't feel like you got to light the world on fire, figuring out all 15 categories in crazy detail. You could spend $1 million trying to do that. And I don't think we're going to get there to start. So just a little word of caution, which is reporting looks very different for Scope 3. So yeah, just keep that in mind. I'm not saying it's not going to be a big undertaking. What I'm saying is each year it'll probably get iteratively better. And depending on which of your categories account for a majority of your carbon emissions, you might end up being expected to provide a lot of granularity in those and not much in other categories. And then the last thing I'll say is Sandhu did a good job talking about science-based targets. So yes, we were talking about the SEC requirements, but if you want to do science-based targets, or if your customers are telling you need to do science-based targets, then Scope 3 is absolutely a part of that. So if it's not SEC, it might be something else. A lot of our clients aren't looking at Scope 3 yet, but they likely will start doing that here in 22 and 23. So if you're like, I haven't even heard of this, you're not as far behind as you think. This is still pretty new and pretty complicated.
Yeah, and I just one more point to add there. I would harken back to one of my points of discussion in the second half of our presentation. Yes, Scope 3 is an enormous undertaking and you could spend lots and lots of money, but there is think about using that Scope 3 evaluator tool to at least get your head around the overall profile and the relative contributions. And that can be done rather quickly. And then moving down the road in subsequent years, you may need to dig into more detail to certain categories that are clearly material, that are clearly substantial contributors to your overall Scope 3 profile.
All right.
I agree with Mike. You don't need to do it all at once. You can kind of do it in a phased approach, and you can start with some simple, not too costly approaches for characterizing Scope 3 emissions.
All right. We had a very specific question came in about category 11 of Scope 3 emissions categories. I had to Google it, but apparently that's products sold. But Rich, I think you were going to try to touch on that one and how that is done and whether there's double counting between different players in the value chain.
Well, but I think the question was, can you get credit for it? So if a company produces a low carbon product, can that company get credit, or an offset for that? And so it's a somewhat complicated situation. I would say, in terms of a carbon offset, which Mike delves into detail on, the answer is pretty much no. I mean, the carbon offset market, while I guess somewhat fluid and immature, has been around for a long time, and one needs to follow established protocols for validating their offset, and it has to be kind of above and beyond business case. So you have to have a established protocol for doing that quantification. And to my knowledge, there are no protocols in existence for a low carbon product. So from that standpoint, you don't really get credit for it. But within various prominent carbon disclosure platforms, such as CDP, you do get to identify any low carbon products that you manufacture, and you do get credit in that sense in terms of the disclosure. So you get to, talk about that. Mike mentioned publicize what you're doing. CDP awards greater point value for those companies that truly are manufacturing low carbon products, and your posture from a carbon risk management standpoint is enhanced.
Yeah. If I can add to that, so Rick's exactly right. You can't sell the offsets. What you can do, and what a lot of companies who are offering low carbon products are doing, so it's called a life cycle assessment, it's LCA. Basically, an LCA is you go out and you figure out how much carbon it takes. And an easy example would be like low carbon concrete. Figure out how much carbon is emitted in your low carbon concrete approach. And then you figure out how much carbon is emitted in a standard concrete. And I'll make up a number. Your low carbon concrete is 75% fewer carbon emissions than the standard. You can go out and do an LCA. Foresight does them. There's a bunch of other consultants that would go out. They'd figure out what are your raw materials going in? What is your process? What does it look like at the end of life? You run all those calculations, and then you can have a document that basically says, my low carbon product is 75% or 85% or 90% lower carbon than the standard. And that is real. And you can take that to your customers if they want it quantified. But again, from like a trading offset standpoint, it's just a little messy. Typically, it's more like, I want to build a building with that's low carbon. I'm okay paying a premium on my concrete because it's such a big part of my carbon emissions or my steel or whatever it is. So the short answer is you can do these things, and this is valuable in the marketplace. One, you'll probably need to quantify it to your customers. And two, you're not going to be able to like sell the benefit from it for your own profit. What it is you're offering a product that your competitors may not offer for a premium. So yeah, the short answer is you can do it, but it's maybe not as clean as the question was asking for, which is like, I'm just going to sell a carbon offset.
Yeah, and great points, Mike. And to pick up on that, I would like to add that there are some regulatory regimes popping in certain states, California leading the way, where you're actually required to do that evaluation, that life cycle evaluation, and show the footprint of your product. And you cannot sell into California without having a footprint number that's below a certain value. Right now, it's mostly focused on high energy intensive industry sectors like cement and iron and steel. But basically what companies are doing right now is they're conducting the LCA, as Mike mentioned, leading to something else called an EPD, an Environmental Product Declaration, which is essentially a third-party verification of the LCA, and that is the footprint number that you're able to share with your, with the general public, with your key customers, to show, that you're better than the average. But also for certain states like California, you can't even sell into the state unless you have a number that's below their designated number in the rule. And we kind of feel like that may begin to show up in other states as well. We're kind of tracking that.
Yeah, thank you, buddy. Another related question was regarding the boundaries of measuring Scope 3 emissions. Our presenters, maybe Sanduni, if you saw the question in there, and can you speak to that?
I'll actually have Rich take on that question if that's all right.
Absolutely.
Yeah.
Any thoughts?
Sure. Well, it's very broad, as Sanduni shared initially, and Mike mentioned just a short while ago. It's 15 categories. It's everything upstream and downstream, that's part of your production process. I mean, the more significant components tend to be category 1, for example, which is purchased goods and services. That's basically the embedded impact in the raw materials that you purchase and use. I mean, it could also include the upstream transportation and distribution, the impact of getting those materials to your manufacturing facilities. Sanduni mentioned the category fuel and energy related activities. That's the embedded impact in producing a unit amount of fuel that you use, not combusting it, which would be a Scope 1 emission. It was like, what did it take to produce that unit amount of natural gas or coal or fuel oil that I use? Those tend to be very significant categories in scope 3. Then there are other ones that are easier to characterize, but maybe not as influential, like business travel or employee commuting. You know, there's waste generation is also a category in there that maybe is not large, but it's something that is pretty easy to get one's arms around. So that would be, you know, hey, how much waste are we generating? You know, that waste goes over to the landfill, biodegrades and yields greenhouse gas emissions, methane and CO2. If we reduce that amount of waste that we generate, that's less going to the landfill, that's less emissions that we have. So there, you know, it's a broad category. If you look at the scope 3 protocol, it tells you exactly what the boundaries are for each of those 15 categories. So it's, you know, it's not a mystery. You can actually, you know, use the protocol, do the quantification, and have a credible number for whatever categories you deem to be relevant. Does that, hopefully that helps.
Yeah, well, I think it does, but I think there's a lot more that, you know, these topics will continue to evolve. We'll all learn about. And I guess just one final takeaway from each of our presenters about what should really companies be thinking about, maybe what's something that they would be surprised by once they get into this process that they really ought to have in mind. So we'll start with Sanduni, if you don't mind.
Yeah. Something that I would like to share is, and I think Mike may have touched on this already, but thinking about all the different groups within your company that you can work with, coming up with the sustainability strategy is really important, because you'd be surprised, the marketing team may already have some information that they've been collecting for a while, or the HR team, or working within the corporate sustainability team, just ensuring some collaboration within your own company as you're coming up with the strategy is extremely important. So if this is something you're starting on, I would highly recommend involving the relevant stakeholders within your own company when coming up with your strategy.
Great. Rich?
Okay. Let's see. I actually have a couple. I'll go quickly. The first one would be to just applaud Mike's presentation and say everything that he discussed was spot on and was, you know, represented a great strategy. We had done a lot of energy assessments under the Boiler Energy MAC requirement, you know, that was mostly applicable to companies, you know, 7-8 years ago. And what we found was a lot of these things like compressed air and insulation yielded very quick paybacks. And so it was amazing to see that. And I think the clients actually thought, wow, you know, we didn't realize that you could get such a quick payback on these things. So I would say everything that Mike told you is absolutely spot on. Do some investigation. You can get, you know, cost savings as well as footprint reduction without having to spend a lot of money. So that's the, you know, just the first thing I would point out. The second thing is that for most companies, scope 3 is a large component of their overall footprint. It's at least 1 to 3 times combined scope 1 and 2, and often 5 to 10 times combined. So it's going to be a big deal moving down the road for you as an organization when you're feeling pressure to make a net zero carbon commitment. So begin thinking about it as soon as you can and figure out where can you reduce the footprint. And I guess those are the two things that maybe people don't fully realize, that yes, scope 3 is a big deal. It's a large component of your overall footprint, and you're going to need to do something about that moving into the future. The other thing is that, you know, I agree also with Mike, do your own organic reductions first, and then think about the available instruments, financial instruments, if you will, that to reduce the residual amount, both RECs for scope 2 and offsets for scope 3.
Last word is Mike.
Yep.
Thanks for the kind words, Rich. And I'll say this, I think the thing most of our clients are surprised by is how time consuming and painful data collection can be. It's actually one of the biggest things we have to solve for our clients. Is we built a software to help them collect and house utility and energy and carbon data. And so I would just encourage you, if you're struggling, it's likely where it's going to be. It's not you. There's a lot of data to manage there, and there's a lot of metrics, and a lot of companies, frankly, just struggle through that. So I just want to offer a word of encouragement. Setting a plan can be hard, but not as hard, and implementing a plan can actually be hard, but not that hard. However, collecting the data on an ongoing basis is a big undertaking. So just a word of encouragement there. And if you ever need any help, you know where to find me.
Thanks, Mike. Just real quick question, I guess, on that. When is carbon reporting season? I know we've got all sorts of other reporting deadlines and seasons that drive the year for EHS professionals. When do they do this?
If you're public, it varies. It's whenever you decide to publish your 10K, if you want to put it in there. But a lot of companies do it on a calendar year. So this is crunch time for us, actually. For a lot of our clients, their data has just finally come in February and March, and they usually want to have something done by the end of March. But again, it kind of just depends. And then I don't know if Sandhu and Rich want to talk about like different platforms.
Yeah, again, the most prominent platform for carbon disclosure globally is CDP, and their deadline is at the end of July. So it's and often companies are also seeking to issue a sustainability report at some point in the summer. Maybe it's just, it's in August or September, a little bit after the CDP submittal, sometimes a little bit earlier, but often, the company is working to collect their sustainability metrics at the same time as they are working to collect their energy and GHG metrics for CDP disclosure purposes.
All right. Well, that was just kind of curious question of mine, but thank you all again for your content today. Again, a reminder for folks who will be sending a follow-up email with a link to the recording when it's posted, a copy of the slides, as well as the contact information for our presenters for any further follow-up with them. Thank you all again for joining us, and have a great rest of your day.
Thank you, you too.
Thank you so much.